Welcome to Make Your Money Matter with Brad Barrett, the show that aims to change the way you think about wealth management. Brad is a financial advisor, established radio host, and author of Retire Right. He is a managing director and partner at One Capital Management, an SEC-registered investment advisory firm managing over $4 billion for clients across the nation. Brad and his team are dedicated to helping clients protect and preserve their assets so they can reach their investment and retirement goals. And now, your host of Make Your Money Matter, Brad Barrett.
Welcome in to Make Your Money Matter. I'm your host, Brad Barrett. I'm also Managing Director and Partner here at One Capital Management. And today we're going to be talking about the Federal Reserve, the Fed. Now, I'm not going to try to bore you, but I want to talk about a narrative and a rhetoric that's been going around. And as you guys know, every week I like to share things that we see every day when talking with our clients and just what people are talking about. I want to share it as a group think in a way. And I think the narrative that rates are going to be going down, and I want to bring some perspective on that from the viewing we had 6 months ago in January to now. And I'm sharing this message this week on kind of the eve, because next week's the next Federal Reserve's meeting, as well as one late in July. And we're going to talk about that along with some data as to why the Fed hasn't lowered rates and what they might be thinking. But before we get started, make sure to go to our website at One Capital Management. You can download our podcast there, as well as on Spotify or SoundCloud or the Apple iTunes app on your phone. And do us a favor, leave us a review and a comment. It helps us share the message. And with that, let's get started. So I wanted to start this week's show on something that happened last weekend. My son, Brooks, who is 8.5, I have a daughter, Kate, who's 6. My wife and I went to, we did his first hockey tournament, Memorial Day spring tournament. He wants to play travel hockey next year. He's been skating for about 2 years now. He's absolutely obsessed with it. And it's been really cool to watch him thrive in a sport that I played for 17 years. I'm one of those dads that I really am laissez-faire about it. I have not even professed to him at all my love for the sport. I think he just naturally knows and wants to do it, which I think is really cool and organic. Anyways, long story short, we're down in San Diego. We get this schedule. Now, for all my parents out there who get a schedule for travel sports, you know what I'm getting at here. So we get it, number one, a week in advance, which is great planning for all of us. And I know there's people out there who've done this before. And we get the schedule. Here's the schedule. It was Friday night, 7 o'clock. Mind you, these are 9 and 10-year-olds, okay? Friday night, 7 o'clock. Saturday night, 7:30. And get this, Sunday morning, the very next morning, the next game, the third game, is at 7 a.m. And then the fourth game, which ended up being the consolation game, they got fourth in the tournament, was at noon on Monday, Memorial Day. So when we get this schedule, we realize we're going to San Diego as a family, and we have legitimately 3 full days, okay, to entertain an 8 and a 6-year-old, not at our house or in our community. So naturally, what do? We look at the finances. I put some money aside for this exact reason, and we basically went to Legoland, we went to SeaWorld, and we went to Belmont Park. We literally threw the full days and then did hockey games in between. But that's not the story. What I'm trying to share is this. At Belmont Park, for anyone who's been down there, I used to spend a lot of my summers there on surf trips down in San Diego and Mission Beach area. By the way, real fun fact, that arcade area down in Belmont Park has been completely redone and is awesome. So any of you out there with kids, roller coasters, arcade games, the whole thing, it's awesome. Anyways, there's an older section of the arcade area that still takes quarters. And so what was interesting was, and I don't know about you guys, but I never carry coins. All right, I had a few dollar bills, I had a 5, a 10, some cash, nothing crazy. So Brooks really wanted to play this game, but it only took quarters. And he looked at me very perplexed because all I had was $1. He said, well, no, Dad, that can work. It only takes 25 cents. But I'm like, yes, but we only have $1. We don't have the coins. Now, to see an 8.5-year-old's mind for a second, not understanding that we have more than we need to pay for the thing that he wants, but not in the exact way it needs to happen. And I think it's funny when you think about those kind of things, it dawned on me that it's interesting how that stuff like that plays out in our life. Context and the way we view things is very interesting. We don't realize that we have enough sometimes, we just don't have it in how we think we need it or want it. And I really think that has to do with our perception. I talk about it all the time. And when we talk about something like today's topic, which is the Fed, it's amazing how we can subliminally garner little tidbits of what's out there in the world of media or our friend discussions or tableside conversations around anything that we want to happen, and we almost like manifest it. And here's what I'm getting at. For anyone out there right now who is in the camp of trying to refi, do a project, buy a second home, or anything like that, you are in the camp of subliminally or knowingly wanting interest rates to go down because debt becomes cheaper, refinancing becomes more opportunistic, so on and so forth. If you're on the other side right now where none of those things are applying, you're somewhat ambivalent to whether or not rates go up or go down. Now, I think in general, we all kind of think we want rates to go down. I spoke about this a couple weeks ago as well, that you have to remember there's two sides to that coin, pun intended on today's story. But what I'm getting at and what I think our main contention have been in recent months, and I want to go back for a second on the Federal Reserve. All right. They switched from what we used to call a scarce reserve model to an abundant model. And in doing so, the Federal Reserve has basically taken over the short-term interest rate marketplace. And here's what I mean. And I'm going to throw a few data points at you, not to bore you, but just follow along here. I think it's important. The Fed's balance sheet has expanded from $870 billion in August of 2008. We use 08, obviously, because that was the last time we had a financial recession, a real big one, right? The Great Recession, to $7.2 trillion today. That, friends, is a 733% increase and has averaged 33% of gross domestic production over this past 4 years in particular. By the way, that's bigger than any time in history. It's really the 1,000-pound gorilla in the room that I want to bring up. Okay, what this means is that the markets are not necessarily, the markets being the stock market, the markets that we call S&P 500, the Dow Jones, whatever you're looking at from a proxy, okay? It means the markets aren't necessarily focused on economic data itself, but are actually trying to figure out what guys like Jerome Powell and the Fed think about the data. Does that make sense? So not long ago, the market was pretty convinced, if you all recall, maybe 6 months ago, that the Fed would cut rates 5 or 6 times this year. That was the rhetoric in late December, early January of 2024. Now, at the Fed's meeting next week, which is why I'm bringing it up this week, there's basically zero chance that it'll cut rates at that meeting or, and this might shock some people, at their late July meeting either. That's the current consensus. So essentially 6 months ago went from 5 or 6 times reducing rates this year in 2024 to basically probability-wise almost zero next week's meeting and in July's meeting. And the lack of rate cuts by the Fed makes sense. And I know it's not a very popular opinion to be made right now, but hear me out. From an economics perspective, it makes sense given the recent lack of progress on inflation. Interest rates are one aspect of inflation. Many people, the media world will let you feel that there's only one side of it. It's if you have inflation, increase rates. If you don't have inflation, you can lower rates. And yes, that is true to a point, but there's also one main big thing is also the money supply. We call it M2. There's M1, M2. It's kind of the Fed's balance sheet of how much money is in the system. Things like CDs, money market accounts, stuff that we have in our checking and savings account. There's an aspect to how much money is in the system. By the way, this is where you get the whole printing money philosophy. So again, without the progress on inflation, it makes sense for us not to crazy lower right now. Now, during the year, by the way, this year ending in April, this last quarter, the consumer price index, the CPI, rose 3.4%, which, by the way, is an acceleration of 3% increase during the year ending from June of 2023. And it looks like, if you look at data, the consumer prices rose only about 0.1% in May. But even with that small monthly increase, this is what I want to bring up, the year-to-year gain would come in at about 3.3%, which is still higher than mid-2023 last year. This is something you're not hearing out in the media. And I'm not trying to be the bearer of bad news, but we still have an inflation issue, all right? And the Fed focuses, as I mentioned before, on other measures other than inflation. One is the PCE deflator, right? It's now up 2.7% from a year ago, but it wasn't that long ago that the Fed basically told markets and investors like you and I that they need to focus on something called supercore. You might have read this, or the media kind of took a hold of this for a couple of days. They called it supercore inflation, which is basically is PCE prices which exclude food, energy, and other goods and housing. And that measure is up 3.4% from a year ago and has accelerated lately, which is why this whole buzz is happening this summer. It's been accelerating. It's been including up to a 4.1% annual rate in the past 6 months. I know I just threw a lot of numbers at you, but here's what I want to bring up here. There's no wonder that the Fed stopped talking about supercore inflation. Not only that, it sounded really dumb, but they stopped talking about it because it doesn't fit the narrative. right? And by downplaying this measure, the Fed is basically signaling that it wants to find a reason to cut.
Stay connected. Get frequent updates on the show. Follow Brad Barrett and Make Your Money Matter on most social media platforms. And catch full episodes of Make Your Money Matter streaming now on our YouTube channel. To schedule your no-obligation appointment, go to onecapital.com or call 805-410-5454.
Now, meanwhile, you've got certain measures coming out of the Cleveland Fed's office. Is at 3.3%. The Dallas Fed measure of trimmed, meaning is 2.9. And none of these are very close to the Fed's supposed 2.0% target. Maybe this is why the inside baseball discussions deep in the Fed and elsewhere are saying maybe we should raise the target inflation to 3. There's a lot of discussion around that. Once again, signaling a desire to cut rates in this election year. Here's the answer, and I know this is going to sound very cliche coming from a financial advisor, an economics, way we look at these things, right? The answer is we don't know. And I joke about this sometimes, but it was told to me years ago by a very well-known economist, someone I very deeply respect, and he said, our job as economists, as investment managers, is to be less wrong more often. Now, that may not bring you a bunch of peace, but at the end of the day, it's a solid philosophy to understand why we active manage, why we diversify, why we study and research and understand trends, both macro and micros, because we're not God. We don't know what's happening tomorrow. You know what I mean? So we have to kind of make sure that we plan for the uncertainty because we don't know what the Fed is thinking. And rather than base forecasts on economic fundamentals and bank demand for capital or forecasting, the Fed has become, is really guessing about motivations, right? In other words, at the center of financial capitalism these days, I think is an unhealthy obsession with the decisions of a government agency. That might be a biased statement, but I do feel like that's worth saying, right? I mean, we focus so much, almost an unhealthy obsession with the decisions of certain government agencies, when the reality is we still have a free market. Yes, I understand regulations play a big factor into certain things. It understands where bank CEOs or big, large corporation CEOs, they understand the sandbox to which their company or their sector or industry is playing in. But we as consumers and as individual investors have almost become obsessed with whatever one party is doing or another party or a certain Fed or a certain Supreme Court. And don't get me wrong, they matter, but not maybe as much as we're giving it credit. Long term, we think what will drive markets, as always will be, as a true American, when a believer in this system, right? Long term, what will drive markets is the process of innovation, the process of entrepreneurship, and ultimately profits. Now, AI, artificial intelligence, certainly, if you look at the data, doesn't seem worried about rates. It keeps going. Now, keep that in mind when I think if you're ever watching, or any nerds like me out there, when you're watching next week's Fed meeting, whether it brings surprises or not to us, because it's interesting to note that certain sectors really don't care what the Fed is doing. And I think what I want to share today is maybe we need to take an approach to that. Not ignoring the fact that what's going on in our economy has some things to do with how we're managing money and where we're working, but a lot of it also has to do with time and context, everything I preach about daily, weekly, monthly, yearly here at One Capital and with our clients. And with that, I hope that I didn't throw too much data at you today, but I wanted to talk about basically this understanding of the Fed, this rhetoric and narrative this whole year about, the Fed's going to lower this, that, and the other. I mean, I've seen lenders and mortgage brokers talk to my clients about, we'll lock in this now and we'll just refi in a couple months. It's like, look, I want everyone to be prepared that we may not get the amount of rate cuts that we are seeing. And I don't want anyone being sold a bill of goods on the expectations that it's a foregone conclusion, because in my opinion, and many out there, it's not. So do with the data what you will. I didn't mean to be too data heavy today and bore you, but I did want to kind of talk about some things in context, why they haven't lowered. A lot of it has to do with inflation not being where they currently want it. But I also think it's a really good thing because end of the day, if you lower rates, the things that are going to be outpacing, things like real estate, for example, it's going to skyrocket and then it becomes more unaffordable and we have a whole other economics of issues. And so this balancing act that Jerome Powell is doing right now, believe it or not, might be the right thing. Now that's time will tell. But the idea of everyone kind of leaning on planning, which is really what I want to attack today, that the rates are going to go down, we don't know that. And so I want everyone to be planned and accordingly. We are here at One Capital for our clients for the planning side as well as for the investment side. I want to thank you for listening today. As always, before acting on anything discussed today, speak with a financial advisor near you about your specific situation. Or again, if you'd like our help, you can reach us at 805-410-5454. And until next week, always remember to make your money matter.
The information in this show is educational and general in nature and does not take into consideration a listener's personal circumstances. Therefore, it is not intended to be a substitute for specific individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.